Recording in progress.
Okay, well, welcome everybody to Reverse Mortgage Weekly. This is something I'm doing every week on Thursday. You get to see my smiling face here from outer space, talking about reverse mortgages. Eventually, I'd like to have people joining the Zoom call, doing live broadcasts from various places around town, and also showcasing people's businesses, things of that nature. Just doing what we can to be of service and to create an environment where people are succeeding and hopefully learning more about the programs that we talk about on the program. So welcome today, Thursday the 12th. Again, this is kind of a interesting experiment for me here. So let me go ahead and share my screen here. Today I thought I would talk about some items here. Let me just share my screen. There we go. Okay, so I'm probably in a really tiny little box over there now in the corner, still in outer space though. So I wanted to talk a little bit about why people are taking out reverse mortgages. I mean, what's the point? You know, you hear a lot of different things about these programs, and you know, there's a lot of misconceptions and a lot of inaccurate information, and some of the information is accurate in regards to these programs. So to really just educate people on the truth, nothing but the truth is really my goal here. So one of the things that I wanted to go over actually really quickly here. So there's two big misconceptions that I get with the reverse mortgage, and that is, let me go ahead and back up the slides here. This is a presentation I do for the state for reverse mortgage for real estate agents. And it looks like our presentation has decided to go ahead and just stop there for us. So okay, that's okay though. We can get it pulled up here again. So the two biggest misconceptions that I have about the reverse mortgage program are one, that once you have a reverse mortgage, you no longer own the property. This is just some of the disclosures that I go over with my students or people that attend the class for the state. Let me kind of fast forward here. So the two biggest misconceptions that I see with the reverse mortgage is that you lose the title to your home. Now, that couldn't be further from the truth, especially with the HECM loans. And remember, when we say HECM, that means Home Equity Conversion Mortgage. So that's the FHA program. There's a lot of protections in place for homeowners for these programs. So the bank is never going to own the house. They're never going to. In fact, this is a much safer program than it would be on a forward mortgage. You know, a lot of folks think that, okay, if something were to happen with my parents or someone who has a reverse mortgage, that it's somehow it's less safe when people pass or they need to sell the property because they're moving into an assisted living facility. That couldn't be further from the truth. In fact, it's actually much worse to have a forward mortgage in that instance. And the reason is that the forward mortgage, the way it's structured, is they have a monthly payment. So let's say you owe $100,000 on a house and someone is moving out, you know, either into a facility or they pass or something of that nature. At that point, that payment is still due each month. Now, if the payment goes past 90 days late, the instructions in the note and the deed and things like that on a first mortgage say, okay, if you go past 90 days, we can file a foreclosure claim and basically auction the house off. And then at that point, if they can file that claim, it's usually around 90 to 120 days. If they haven't received a mortgage payment for 3 to 4 months, they can file that claim. And then once they file that claim, it's about 90 days before they auction the property off on a sale date. I have a lot of extensive knowledge on this because in 2008, when everything, just fell through the bottom, people were losing their homes. I was working at Chase Bank in their loss mitigation department trying to help people save their homes. So there's a very detailed process in regards to the foreclosure process and foreclosure proceedings and things like that. And on a forward mortgage, if you're not making those payments, then you can put yourself in a position to get into foreclosure. However, with a reverse mortgage, you're not going to be putting yourself in that situation because there's no monthly payment. So when people pass, what happens is that they'll give the heirs 6 months to figure out what to do with the property. So there's a 6-month window where the heirs can either sell the property, they can refinance the existing balance into just a regular mortgage and keep it as a rental or keep it as a family home, whatever they choose. And the third thing that can happen is they can actually file for 2 free 3-month extensions. So that means that the heirs will actually have an entire year to determine what to do with the existing real estate. So on a forward mortgage, I mean, you've got, that 3-month period, and then you have the foreclosure, all the fees, everything associated with that. So with a reverse mortgage, it's actually much, much better to have a reverse mortgage than it would be a forward mortgage in that circumstance. So, but to get back to the original query here of losing title to your home, you don't lose title to your home. The title is kept in the person's name who owns the property. There is a lien put on title, just like there is with any other mortgage. Saying that you lose title to your home on a reverse mortgage would be the same as saying that anybody who has a mortgage loses title to their home, because it's the same exact process. But I think what people really get frightened about, one is the closing costs on a reverse mortgage. But the second thing is that there's a sentiment that people are going to be upside down on their properties right away with some of these programs. And that's not the case at all. Now, there are a lot of factors that are involved in that. So one of them being the housing market. Now, if we have 20% appreciation year over year in our housing market, it's going to take someone virtually forever to go upside down. It would never happen in this type of climate. Now, do we think that's going to happen? Do we think that things are going to stay at 20% appreciation year over year? I don't know about that. In fact, some people even say it's going to start slowing down now because of inflation. There's less borrowers that are going out into the market looking for properties because the rates have really increased significantly. So, but I don't think it's going to slow down but it could, if it slows down, then obviously appreciation plays a role in the negative amortization of these programs. So, on the amortization of the programs, depending on where your interest rate is at and your margin, those are going to be the 2 factors that determine what your negative amortization will be year over year. And when I do estimates for my clients, that's one of the main sheets that I always print out for them, is that amortization table, because people want to know, if I take out a reverse mortgage, am I going to be upside down in 2 years? And that with the amount that we can borrow against these, basically 50%, 45 to 55%. Again, it's going to be based on your age, but with the amount that we can borrow, there's really the conception that you would go upside down in just a few years is really just not warranted. Now, if we have another 2008 event, all bets are off. If we start losing values in homes and things like that, yes, people are going to go upside down, but not just reverse mortgage people. People who are in forward mortgages are going to be in that situation as well. Do I think that's going to happen? I don't. I really don't. I think things are going to slow down. I think things are going to, plateau, maybe get to a little bit of a normal appreciation, but I don't think we're going to be in a situation where, property values are just falling like they were in 2008. In fact, I saw this, getting all my advice from social media, right? So I saw this gentleman, expert, today that says he's predicting that all the property values are going to drop by 10 to 30% in the next year because of inflation. Now, I find that really, really hard to swallow and really hard to really calculate because, the markets are built off of supply and demand. And right now we have a very low supply of housing, very high demand for it. So as long as that exists, you're still going to have a situation where things are going to be increasing in value and things like that. So in some markets that may happen. I don't see that happening in Colorado. But getting back to the myths. So the first myth that I come across a lot is that you lose title to your home. Of course, that's not correct at all. Second is that you're upside down on the property after you take one out. And over year, and depending on which program, the HECMs are the programs that I always will recommend for folks. I think they have a lot of great protections. They're much more expensive than some of the other programs. They charge a 2% upfront mortgage insurance premium, and that's 2% of the property value. So $600,000 home, that fee is going to be $12,000. Now, a lot of people associate that fee with a reverse mortgage, but it's not a reverse mortgage fee. That's an FHA fee. Some of my first-time home buyers that purchase a property with an FHA loan, they're paying virtually the same amount, about 1.75% on 96.5% of the purchase price. So as you could imagine, that's still very, very high, and that's just how the programs are built. So you're probably asking me a question right now, well, Zach, you just said that those are the ones you recommend, but they're charging a 2% fee. Well, yeah, because over the long run, if you're looking to stay in your house for the long haul, and you do not want to make a monthly payment, or you want to open up a line of credit and use that as part of your financial planning tools, in my opinion, I think the HECM is the best product, mainly because the interest rates are much, much lower than they are on some of these other proprietary programs. So what does that mean? That means that your amortization on the reverse mortgage is going to be a slower process. Year over year, because your rate is lower, your amortization is not going to accelerate like it would on some of these proprietary programs. Now, is there a place for the proprietary programs? Yes, I believe there is. And I think there's a lot of space in that because if it's going to be like a short-term type loan, something where you just want to access cash to, or if it's part of your financial planning tool. For instance, the second I turn 55, I'm going to run down to the bank. I'm going to run down to the bank and get a reverse mortgage. And people are saying, well, why? If it's because that's part of my financial planning tool. I'm going to eliminate that mortgage payment as quickly as I can. And then I'm going to start taking the money that I would normally be paying with my mortgage, and I'm going to put it into something else, something that I have access to, something that is liquid. Equity is great to have, but, we can't eat equity. Equity is, it's like having a glass coffee table in the middle of your living room full of cash that you can't access. So that's just part of my plan. So being upside down on the property the second you take out a reverse mortgage is really a big misconception. Now, is it possible that you can go upside down on these programs? Yes, absolutely. But one of the protections that you have with the reverse mortgage is that they are what's considered a non-recourse loan. So let's say someone takes out a reverse mortgage and for me, example, if I take one out when I'm 55 and my interest rate is really high, we'll say 9% on the reverse mortgage. Now, 8% is not uncommon on some of these proprietary programs. So at 8% every year, that's going to be added on to the loan amount. So let's say we have another 2008 event, or things really start to slow down in the real estate market. I may be in a situation where if I borrowed the maximum I could at 55, and I'm not making that monthly payment each month again, so that's where I see the benefit. But if we get into a situation where the housing market stalls, and I'm still getting charged those payments, and I live to be 100, well, I'm going to be in a situation where I'm probably going to be upside down on my property. So but the good thing with these programs that they are a non-recourse. And what that means is that they can't go after any of the deficiency for your heirs, or that's another misconception. I think if you go upside down on the program, that you're going to be in a situation where they can, go after your heirs, or you owe that money or anything like that. No, it's still a non-recourse where, let's say the reverse mortgage balloons to $1 million and my house is only worth 500,000. Well, the bank is going to be stuck holding that, holding the rest of that, because they're not going to be able to come after for any deficiencies. So in that situation, I may be upside down on my house, but what people don't realize though is that for 45 years, I didn't have a mortgage payment. So, I mean, if I had an extra, $2,000-$3,000 each month, even in, some folks are gonna be like, well, you would have paid off your house in 30 years. Well, big deal. I got a big piece of equity. I got a big piece of something that's not liquid. I can't take a picture of my house and go down to the grocery store and pay for my groceries. But if I have that extra cash flow, if I'm not paying that $3,000 per month, I can put that directly into my pocket. I can put it directly into my bank account. And then I have 100% access to that cash. It's just like folks who buy homes for cash. I'm not a huge proponent of that. I really feel like people should leverage real estate. You get a great tax write-off with the interest, or you can stay liquid. Traditionally, if you wanted to get a $600,000 home and not pay cash for it, or didn't want a mortgage payment, you'd have to take $600,000 out of your prior sale, or out of your current residence, or whatever the case may be, out of your investments, and you'd have to put that down cash on the property. And a lot of people, that's their philosophy. Buy your house cash, pay your house off, fast as you can, get into a 15-year, eliminate all your debt. We all have folks out there that it's like that, but I'm more of a Robert Kiyosaki believer in the sense that there is good debt and there is bad debt. But once you put that $600,000 into that transaction, well, you just gave up control of $600,000. You no longer control that. It's all in the property now. So what I mean by that, you take that $600,000 and you basically either handed it to a buyer or you handed it to a bank. And because if you want to get that $600,000 back out by paying that house cash, you either have to go to a mortgage person like myself and ask for a loan to get that money back out, or you have to get a buyer to buy the property, and then you would cash out those funds. So that $600,000, you basically said, you know what, I'm going to take this big stack of $600,000. I'm going to place it into this glass coffee table right in my living room, and I'm just going to stare at it this whole time. So that's really the concept of using equity, and basically converting that equity to cash is a huge advantage, especially for retirees. Retirees, one of the biggest issues that they deal with is cash flow. And I'm very aware of this. It's very humbling working with older adults, because you begin to realize that time is very precious. We can always make more money, but we can't make more time. And at the end of the day, someday, if I'm lucky, my body will break down and I won't be able to start to be able to work as much as I am now. I'm very aware of that. So at the point when I want to retire, when I want to start slowing down, when things start to, when I start to come to the seasons of my life where I'm, slowing down, I don't want to be out there busting my hump trying to make as much money as I can. I'm not going to be able to. So that cash flow, and, obviously everybody's plan is to retire with, enough to live off of. Very few of us achieve that goal. But so folks who are in a situation where they're not able to work as much, they're living off Social Security, they don't have a large amount of savings. And on top of it, if they have a large mortgage payment, it's just not a great situation to be in. So by accessing or converting that mortgage into a payment optional program is a great benefit to them, because they just gave themselves a raise. They basically, the money that they would be putting into the mortgage is now going into their bank account. And yes, it's a trade-off. You're trading your equity for cash, but I mean, that's what most people are doing anyways, for the most part. I mean, you hear all these mortgage companies, pay off the high interest credit cards, do this, do that. Is it a great idea? No, it's not a great idea to pay on your credit for 30 years. But if you already have the debt, what's the other alternative? You got to pay it off somehow, and paying with your equity is something that can be done. So anyways, our 20-minute is up here. Again, thanks for joining, anybody who's joined in on this, and I wish you much peace, prosperity, wisdom, health, all good things for you and yours. And feel free to tune in every Thursday at 11 o'clock for a Reverse Mortgage Weekly. I'll be from a different planet every time here. Today, I think we're hovering around what is that? I think we're in the space station today. So anyways, I hope everybody has a great rest of your day. Thanks for tuning in.